Hello and welcome to this special edition of Indianomics. I have with me as guest the boss from Mint Street, the man who just recently gave all of us a bonanza with a 50 basis point repo rate cut. Dr. Subbarao, thank you very much for joining us on CNBC-TV18.
Thank you, Lata. It's a pleasure being on CNBC.
Okay, so to start with the monetary policy itself, you've been very generous with this 50 basis point cut. But what makes you so sanguine on inflation? I know your target for the full year is 6.5, but although core inflation has fallen, just in March you have had a slew of tax hikes, you have had railway freight hikes, you have had It would have made sense perhaps to wait and see how all this is getting passed on or not passed on, and then give another 25. Why did you hurry?
Thank you very much for that question, and please allow me the indulgence of an extended answer because that is central to our monetary policy stance. Yes, you've given part of the evidence. First of all, I want to say that 6.5% March 13 inflation is not target so much as projection. But let's look at the growth inflation numbers. Ultimately, in making the monetary policy, there's a lot of analysis done, but eventually it's a judgment call. Okay? Look at the growth numbers. Growth had decelerated last year from 7.7% in first quarter to 6.9% in second quarter to 6.1% in the third quarter. Okay? Investment had turned negative in the second and third quarters. And look at the inflation numbers. Core inflation, which ruled above, headline inflation, which ruled above 9% for over 2 years, had come below 7%. Core inflation, which was above 8%, peaked at 8.4% in November last year, had come below 5%, which is come below 5% for the first time in 2 years, and is close to the recent long period average. You must also remember that we had last hiked policy rates in October 2011 when inflation was about 10% and core inflation was above 8%. So we had to acknowledge that inflation had come down, growth has moderated. Looking ahead, yes, there are upside risks to inflation, some of which you had mentioned. There is oil prices, there is fiscal deficit, depreciation of the currency, there is monsoon outlook, there is food inflation, all those upside risks are there. But we thought it's important to cut rates now, to revive investment sentiment, to have the banks reduce the lending rates and improve credit flow.
No, it's just that it might, unhinge inflation expectation when you get such a big bonanza from an otherwise conservative central bank. It might unhinge inflation expectation. That fear is there.
Yeah, I wouldn't rule out the possibility, but you must note that in our macro document, we have reported the inflation expectation survey, and as we've said several times, that is not an accurate indicator of the magnitude of inflation, but of the direction of inflation expectations. They've come down over the last 2 quarters.
Fair point, sir. Let me come to the other issue that has always pulled you back from cutting rates, which is obviously fiscal deficit and the inability of the government politically to pass on the prices of petroleum products. Now, you have almost read the Riot Act. Would your next move on the policy front be only when you actually see results? Because the evidence has not been very strong. Look at the railway passenger fare hike. It was legitimate by any standards, but politically it was not possible to pass it on. So therefore, would you say that next I will move only if the fisc shows that it is able to move?
Well, I cannot be as pointed as that. Okay, because you cannot run public policy, indeed you cannot run monetary policy on an adversarial stance like that. But we have made our expectation very clear that it's very important that the government delivers on the 5.1% fiscal deficit, and the most important thing to deliver on that is to make an adjustment on subsidies, particularly petroleum product subsidies. So that's very clear. But whether the next move will depend only on that is, I cannot really speculate, I cannot really say.
Okay. Your admonition of the government will become more credible if you held out. If you didn't, then it might weaken the only chance one has to force certain politically tough decisions, isn't it?
Well, I have a lot of respect for your opinion. I'll keep that in mind.
Thank you, sir. Well, let me come to the other issue which has held you back, the current account deficit. By encouraging consumption, there is always a chance that you are going to increase the import amount and therefore endanger the external balance. Would not that consideration continue? Does it give you enough elbow room to move further? Since, as you said at the press conference, you have limited space, but you don't have nil space on moving on rates. Would current account deficit be the one reason why you cannot move ahead?
Well, that could be one consideration. We've spoken about the impossible trinity several times. So our monetary policy, in a way, is influenced by external sector developments, particularly on the current account deficit. And I do recognize the point you're making that because of the high current account deficit is a reflection of the excess demand in the economy. But as demand has abated, we do hope that that will have an impact on current account deficit as well. But go ahead, you have any questions?
No, I was just thinking that, we just had emphasis results and the numbers were a shocker, indicating that, that one big source of money that India has had in terms of software earnings could be in danger. There are a lot of people who believe that NASSCOM may be forced to even lower its earnings expectations. They have some 13-14% growth expectation. That may not be the case. So, do you see that opening another front in terms of worry?
Well, it certainly is a concern. I am, in fact, your reference to software exports, etc., is a trigger for me to drill down the current account deficit. Now, current account deficit is high. We need to bring it down. And in order to bring it down, we need to increase our exports, reduce our imports, and improve our invisible earnings. Okay, the software exports that you talked about fall into the invisible earnings. But first, exports in the short term, there is nothing much we can do. We are somewhat hostage to the external situation. Of course, in the medium term, we can improve our competitiveness. On the import side, the big import items last year were oil and gold. Okay, on oil, if we make the adjustment, I do expect that there will be some reduction or some impact on demand and therefore on import demand. On gold, as we bring inflation down and as people are assured of a low inflation scenario, their appetite for gold and the need to hedge against inflation by investing in gold will come down. So these are not things that are going to happen overnight. But I believe that our action yesterday was directed more towards redressing the current account deficit rather than exacerbating the current account pressures that you had pointed to.
Okay, but well, one hopes that it happens that way. But a more immediate factor that might affect the current account deficit could be this whole uncertainty over anti-avoidance rules. It's possible that purely because of the lack of predictability or because you feel you are being unfairly treated or other countries treat you better, capital flows might stay back. Has RBI written at all to the government what is RBI's concern from a current account angle on this anti-avoidance rules debate?
Well, we have a concern about balance of payments management, and to the extent that taxation issues or in particular GAR have an implication on capital flows coming in, it is of interest to us. However, I'm not clued into the precise details of this, but the general point I want to make is that we need to run a taxation environment, a tax regime that is predictable, transparent and contestable. On the other hand, we cannot forsake what is in our larger national interest. So I would take that decision in the budget at its face value, and I do hope that it gets resolved soon.
But you have not written to the government Any concern from the current government?
That's a privilege. That's a matter of privilege, okay?
All right. Well, the other issue, at least last year, one of the ways in which the government and the Reserve Bank sought to tackle the external front was by giving FIIs more leeway to invest in government securities and corporate bonds. Is that window still available at all? Because we have gone a long way. We've come to 15 billion, and now the extent of short-term debt as a percentage of total external debt could be uncomfortable. Over 40%, I understand. Are you contemplating? Do you see more headroom for FIIs in G6? That solves two problems: bond market appetite as well as external flows.
Well, as far as external flows debt management is concerned, let me give a slightly more nuanced answer to this. We need to bring current account deficit in the medium term, or indeed even in less than medium term, and in the short term the question is financing of the current account deficit. Okay, so historically our policy has been to allow unfettered access to foreign investors on the equity side and use levers on the debt side, and that's precisely what is reflected in our calibration of FII limits both for GSEC exposure as well as corporate bond market exposure. The limit is $15 billion, as you know. I cannot really comment on when we might increase it, if we might increase it at all, but that's the limit now.
Do you think there is even headroom to increase FII exposure to G6?
Well, if the limit is $15 billion, I cannot really speculate on what we might do on the TV media. But we would be quite prudent whenever we do that. We would look into our balance of payments viability, but also look at the need for financing the current account deficit in revisiting that headroom.
Well, so then a philosophical question really on the external debt management. Post the Lehman crisis, or maybe during your regime, repeatedly Reserve Bank has said that we want a hands-off approach on the rupee, and by your actions also have been that way. We didn't see an increase in reserves, although the rupee went to 44 and even threatened to get into 43 at some point in early 2011. This is in sharp contrast to previous times when the RBI actively gathered reserves, even when the rupee was under pressure in the early part of the 2000s. Do you think now that merits a rethink, because we are once again in a current account deficit tension situation, exports under pressure, need to encourage them? So would Reserve Bank, the nuance of rupee management change in favor of more active intervention so that we build up reserves?
I do not think so. Exchange rate policy remains what it is, which you know very well, to smooth volatility and to prevent disruptions to macroeconomic stability. Of course, reserves have come down in absolute terms as a proportion of GDP, as a proportion of external debt. By a number of indicators, reserves have come down, and we need to improve our self-insurance by building up reserves. But that has to happen as a consequence of balance of payments developments rather than an active exchange rate management.
Well, an active or permitted depreciation of the rupee would always be beneficial to encourage exports. Would not that be a philosophy of the Reserve Bank?
I believe that our economy will be better served in the long run if we have our exchange rate market determined, rather than have a bias towards depreciation, because as much as there are some people who benefit from depreciation, there are a lot of people who benefit from appreciation of the currency. I believe that it must be market determined.